This is Spencer Carenti from Alkaline Advisors, and I am going to be walking you through this financial model, which is focused on retail, office, and industrial. So I'm going to quickly start by giving you a run through of all the tabs, and then I'll dig in more depth into each tab and fully explain how the model operates. But to start, this is a 10-year model. It's broken out by month and it's fully dynamic, meaning you change the information or your assumptions in the blue cells and the rest of the model updates accordingly. So I'll start with the rent roll tab. This is where you put in all of your leasing assumptions for your tenants. You'll see it's broken out into the first generation leasing assumptions. I think you have up to 20 tenants you're able to plug in. Then you have second generation leasing assumptions, and I'll walk through this in a little more depth later. Then we have the underwriting section. This is really where the meat and potatoes of the entire model is housed. It's separated into two sections as well. You have the assumption section up top, and then underneath you have the underwriting section. So within the underwriting section, you could see what the acquisition situation looks like, your operating statement, your reserves, your debt section, and then your sale of the asset section. And all that flows into two lines. One is the net unlevered cash flow, so that is your returns assuming no debt. And then the next line is your net levered cash flow. So those are your returns assuming debt. So after this tab, we have a tab of other assumptions. This is general other capital expenditures. So other costs associated with acquiring the asset. So these are the capital expenditures for year one. And then these are just general capital expenditures that are required throughout the life of the asset. And then underneath here, you have closing costs. You can choose whether you're using estimated closing costs or if you have a detailed list of your closing costs. Next, we have an annual summary. So this is just a snapshot of the underwriting tab, but annualized. So as I said before, the underwriting tab is broken out by month for 10 years, and this is just broken out by year. Then we have a partnership returns tab. So this is a 4-tiered equity waterfall structure. You could choose what percent of the equity is being contributed by the general partner, and that calculates what percent is being contributed by the limited partner, and you could set different IRR hurdles with different promotes attached so that the distributions at a property level are flowing a certain way to the general partner versus the limited partner, depending on the returns that the property generates. And then you have some fees you can throw in that the general partner will receive, but I'll walk through this again in more depth later. And then finally, we have a lender summary. So this is just a snapshot you can send to your lenders. Hopefully it makes your life much easier. This is fully automated, right? So this is tied to all the other parts of the model, and this will update with your information. And hopefully you just print this out and you're able to get some debt. So with that being said, let me dive in a little deeper to the rest of the model. So we'll go back to the underwriting tab and you'll see, let me zoom in. We'll start with property overview. This is just some generic information on the property, and some of this is tied to the lender summary, so you're going to want to make sure all this is filled out. But this, for instance, if we type in property test, you'll notice, press enter, that is now plugged in here. So just updates based on your inputs. But now let's hop into the actual calculation portion and how everything works. So we're going to start with the other assumptions boxes up here. You'll notice we have information for acquisition, information for operations, sale of the asset, some taxes, and then reserves/CapEx. So in the acquisition section, you can type in the cost of the asset, right? What's your purchase price? So you'll notice whatever you type in here, let's make this 1.1 million. That updates automatically down here. Now that is 1.1, where before it was 1 million. And then for the purchase date, that purchase date is going to be what drives the rest of your calculations in terms of the dates. So you'll notice whatever you put here, it's going to take the month of your input, and it's going to take the last day of that month, and that's what quote unquote year 0 is going to be. That is going to be when you're essentially buying the asset. And then the rest of the model calculates by the first day of, we'll change this. It should be by the last day. There we go. The last day of there we go. The rest of the model calculates by taking the last day of the next month, and that's going to be when the cash flows come in. So here we're saying you're acquiring the asset 9/25/22, and that's why we're starting at 9/30/22. All right. So next we have credit for free rent. So this is just essentially if the seller is providing any free rent, and what we do is we just take that off the purchase price. So you'll notice if you make this 100,000, then the purchase price is now 1 million instead of 1.1 million. So we'll make that 0 again. Next we have the estimating closing cost section. So right now it says estimating closing costs, but as I said before, all of the blue cells are the cells you're able to edit and drive the rest of the calculation. So you can actually toggle between estimated closing and detailed closing. You'll notice right now if we choose detailed closing, that's going to jump to 36,000. And the reason that happens is because when you choose detailed closing, it takes the sum of your actual closing cost box. But if you don't have all these drawn out yet, you could use an estimated closing cost, right? And then just type in whatever you want here, prior to the purchase sales agreement, post purchase sales agreement, and it's broken out by travel, third party, legal, other. I mean, you could really just type in whatever estimated closing costs you want, and then that would generate here. So let's toggle this back to estimated. That's going to be about 2.27% of the purchase price. Then you can choose, are you paying a broker fee? If so, what does that percent look like, right? Let's make that 2.5% just for illustrative purposes, and that updates here. And then finally, based on the immediate CapEx you're spending, so assuming you're acquiring the asset for 1.5 in terms of the sale price, but then you need to put in, let's say, $300,000 into renovations, right? What you'll do is you go to the other assumptions tab, and here is that immediate CapEx, so year one. So what renovations are you going to do to ensure that this asset is now able to maximize potential? So here, let's say we're going to spend $200,000 on exterior CapEx, but essentially you can build this out to be specifically targeting however much repair or however much investment you're putting into the property. And you'll now notice this says 300,000, about 120 per square foot. We'll get into the per square foot in a minute, but that 300,000 is now showing here, and you could choose how this cost is allocated. So that's going to be in this immediate CapEx section. Right now we chose that it's allocated over the course of the first 4 months. So you'll see month 1, month 2, month 3, month 4. You have that 300,000 evenly distributed across those 4 months, which will inevitably affect your cash flow. But what you could do is you could make this 12 months, 11 months, 10 months, right? Let's make this 10 months, for example. And now that is 30,000 allocated over the first 10 months. All right, so that is the acquisition section. Next, we're going to go into the operations section. So this is going into the operating statement. So we come down here and you'll see you have some blue tabs over here for your operating expenses and a little bit for the vacancy for your operating income. But we're going to start by now headed to the rent roll tab. So this is the gross potential rent section, and this is pulled from the rent roll tab. So if we hop to the rent roll tab, this is what it looks like. You can make it nice and neat, right, by pressing that one button. You'll see the sections in this tab are first generation lease schedule, second generation lease schedule, leasing commission schedule, tenant improvement schedule, and then finally building occupancy. So if you blow this now out to the 2 button, this is a snapshot of everything. And this gives you, as I said before, I think the opportunity to plug in 20 tenants, but we're going to keep this here showing only 5 for now. I pre-populated this first tenant, and you'll see we have tenant A, suite 101. This is where the square feet number is populated from. So currently we have that there's 2,500 square feet for this first tenant. So the whole building is 2,500. If you have leases that aren't yet populated or don't have tenants, you could say vacant A, this is 201, let's say suite 201. Let's say this one is 5,000 square feet. Let's say you do have a tenant in this one actually, but the tenant isn't yet a current tenant. They will become a tenant, let's say, in November of 2022. And remember, you're acquiring this asset in September 30th, right, of 2022. So let's say this is 11/1/22. Let's say the duration of the lease for this new tenant is 36 months or 3 years. Let's say there's going to be 2% annual growth. And let's say per square foot, the tenant's going to be paying $31 per year, okay? Let's say that there's a leasing commission for this tenant because the tenant is coming in November 1st, 2022. Let's say you know the broker, you've already said, hey, look, if you bring this tenant in, we'll give you 3% of their first year's lease value. So let's make the tenant or the leasing commission 3%. And let's say actually, this is going to be tenant B, but they start November 1st, 2022. So you'll now see that tenant B is populated here with the rent starting November, the rent that you're collecting. Let me zoom in a little bit. You're collecting that rent. They start November 1st, 2022, but you're going to be collecting that rent November 30th, 2022, right? The last date of that month. And for the first 12 months, it's going to be, the rent's going to be $12,917 per month. And then after that first year, so in that 13th month, it's going to increase by 2%, and it's going to next be that $13,175. And this tenant, we say, is in place for 3 years, right? So you'll notice after 3 years, their lease expires and you're no longer generating revenue here. So now we're going to hop into the second generation leasing schedule. So what we have here, let's say that, same thing with tenant A, their lease expires in 36 months. You can choose between their lease expiration date and then when you think the next tenant is going to come online, how many months is that going to be? So let's say you think it's going to be 4 months. You'll notice that you're offline, you have no rent for 4 months, right? So 0, 0, 0, 0 for 4, same thing, 0 down here. But then 4 months later, you're back online with that new tenant. Let's say you think they're going to be in place for the duration of your hold period. So you're going to put this in as 120 months or 320 months, 360 months, however long you think. Let's go back to tenant B and say that they're going to be in place for indefinitely, right, for the foreseeable future. Or you could say they're in place for 36 months. After that, you think they're going to re-sign, so you're going to say there's going to be no downtime. And then their next lease will be, again, indefinitely. You could say, plug in the same amount of annual growth, and then also rent per square foot. Let's make this, again, this is going to be the rent per square foot per year. And based on the growth over here, you'll see the maximum rent per square foot per year that they're paying is $32.25 when that other term expires. So if you make this 37, that's going to be that fourth year, the first month of the fourth year, to see what that would be, and that would be 32.9. So we can go over here and make this 32.9. And then it just shows you what their rent per year is. Now you'll see these two tenants are in place for the remaining life of the model. Down here, we'll see the leasing commission schedule. You'll notice for tenant B, you're paying $14,231 in month 2. Well, that is because the new tenant comes online in month 2, and you're paying a 3% commission of the rent per year for that first year. So that's going to all come in play. The date of that new tenant coming online, and that's going to be what you're paying out. So this is for the first generation leasing commissions, and then this is the second generation leasing commission. So again, second generation leasing commissions based on your assumptions of the second generation tenant coming online. That tenant A is coming online in month 40, assuming 4-month downtime from when their first lease ends, and we have that there's going to be a 5% leasing commission. So that's why there is that leasing commission for the second generation. And then it's the same thing with tenant improvements. We have it going by tenant improvement per square foot. So if we make it $5 per square foot, again, this is going to start $126. So you're going to be paying this $130, $126, $5 per square foot. There's 2,500 square feet, so total of $12,500 when that tenant starts. So if you come down to the tenant improvement schedule, you'll notice nothing for that first generation because we set those to 0. And then for that second generation, that $12,500 is going to take place the same time as that leasing commission is going to take place for that second generation tenant A, which is the first rent check you're going to get from that new tenant. Finally, we have the building occupancy being calculated down here, and you'll just notice that based on our assumptions, the tenant or the building starts at being 33% occupied because you have 2,500 square feet already online when you acquire the building, and then the outstanding balance of the square footage, which is 5,000 square feet, that's going to come online in month 2. So you'll notice the total square feet for the building is 7,500. Once you're at 7,500 square feet, collecting rent from all 7,500 square feet, then your occupancy is at 100%. And this will be 100% until month 36 and 39 based on our assumptions, where we had a 4-month downtime. So, now that first tenant's out, so you're at 67% occupancy until they come back online, you're at 100%, and then our remaining assumptions keep us at 100% until, or I guess indefinitely. So that is the rent roll section. So this line item, and for the first generation total rent and the second generation total rent, that is what's being pulled into our gross potential rent figures. Then we've hit that line with a vacancy percent. We just chose 5%. You can set this to be whatever you'd like, and that comes into the total rental income line item, which is right here. Finally, we have the ability to add an other income, right? Maybe you'll have vending machines on site. Maybe you'll offer cleaning or whatnot. So what you can do is in this assumption section, you can choose the other income per month when that starts. So right now we say it's starting in month 2. So you'll see that we say it's going to be a total of $250 per month. We say it's going to be $500 per month, and it starts in month 10. You'll now notice $500 per month starting in month 10. And we can hit it with a growth rate. So right now we have other income growth per year at 3%, expense growth per year at 2%. And then based on the recoverable expenses that we're going to input, we can set what percent we think of those expenses we're going to be able to recover. So that's in the expense section, right? We're starting with the property taxes in the expense section. So you have total taxes, total management, common area and maintenance, and then those are what the total reimbursable expenses are made up of. And then that's where that percent expense recovery section comes in. So out of all of these expenses, what percent are you recovering? And even if it's set to 100%, it's actually, you'll notice for the expense recovery, right, 100% recovered. In this scenario, you're recovering 100% of the total reimbursable expenses, but you're multiplying that by the percent occupancy of the building, right? So if you only have 33% occupancy, you're not getting 100% of the expenses recovered because you only have a third of the building occupied. So you're going to be responsible for picking up the remaining part of that recoverable expense section. But obviously, once you're at 100% occupancy, then you're recovering 100% of the expenses if you set your expense recovery percent to 100%. Okay, so then we're going to the tax section. So you could set the tax rate, right? Essentially, this is the mill rate. Once you set the mill rate, you're going to be taking the mill rate of your purchase price. You'll notice the property taxes, it's per year, so it's that purchase price. times the mill rate, and then it's multiplied by the percent of the purchase price, right? So it's essentially the assessed value. So is it 1.1 million what you purchased it for? If it is, make that 100%. If it's less, you can toggle this to be 80%, hit it at a discount or a premium, and then that's going to show you what your annual taxes are. And then you could choose whether or not you have a franchise tax. You could say yes or no. If you say yes, you'll see franchise tax. It's just the purchase price times a percent of the land value and a percent of the annual tax. So you just set this to no, and you'll notice now that line item goes to 0 for the franchise tax. Property management tax, we have a dollar amount per square foot per year. So here, right now, based on the dollar amount per square foot per year, you're showing that it's going to cost $138 per month, and we're growing that at 2% annually. So you'll see that starts at $138 per month, and then it goes up to $140 in that year 2. So that is property management, and then there's an additional management fee, which you can set to 0. You could set to whatever you'd like to set this to, and this is actually pulling a percentage of the effective gross income. And you can also tie this into, the fee that the general partner is getting on the partnership returns tab, which I'll walk you through later. But that gives you the total management fee. Finally, you have the common area and maintenance section. You have the total utility section. So you have common area maintenance, you have other utilities, that gives you the subtotal, and then totals the total reimbursable section. Underneath, you have some non-reimbursable expense items. So we've got some general liability, environmental, contingency, and that is what we'll call it supplemental insurance section is. And you can update all of these line items depending on what you'd like to see in the line items. Finally, you have some expense drag. So, anything that you think might come up, but it's miscellaneous. And then that gives you your total non-reimbursable expenses, which when you add up the total reimbursable plus total non-reimbursable, you have total operating expenses. And again, you're going to subtract out the expenses that you're recovering to give you your net operating income. And over here, you can see what your net operating income is and what all of your annual costs and revenues are based on the time of stabilization. So you'll notice for the occupancy figures, we're at 33% until month 2 based on what our assumptions look like in the rent roll section. So this updated automatically, right? So this is saying we're at 100% occupied in month 2. So once we're at 100% occupancy, then this will auto-populate to the month where you are at 100% occupancy, and then these figures will take that month's numbers and multiply it by 12, so you can kind of get a snapshot of where you are at stabilization, right? And that's what these are. So after the operating statement, then you have the capital cost section. Now the capital cost section, this is where you're going to see the tenant improvements, the leasing commissions play out. So this is everything you're paying pre-stabilization. So stabilization and pre-stabilization, right? So that $14,231 for the leasing commissions for that tenant B that we said, that's going to be factored in pre-stabilization. And this is, again, just for illustrative purposes. You can see what you're operating at pre-stabilization, your NOI less capital costs. So this is taking all of the months pre-stabilization and adding it together. So you have month 2 and month 1. Because you're stabilizing so soon thereafter, that's going to be $9,850. You're going to hold back some reserves, which you do right here. You can choose what amount of reserves you're holding back per square foot per year. You'll see I'll show you what that is on an annual basis. But this is telling you what your total adjusted NOI is based on or prior to stabilization, and then this is what your total adjusted NOI is prior to selling the asset. So we're going to assume, based on these assumptions, we're selling the asset in year 5, which is month 60, and we're selling it at a 5.5 cap, which I'll get into in a minute. And so for these capital costs, you'll see the one-time capital costs and the CapEx equity paid on financing. These two line items are coming from the other assumptions tab. We already talked about the immediate CapEx, and next we're going to talk about this one-time CapEx section. So let's say you know that you're going to have to pay CapEx on something. Let's say it's common area, but you're not going to pay this until you think it's going to be month 24, and you think it's going to be $10 per square foot per year for a total of $75,000. Well, because you're going to be collecting reserves, you can choose where these funds are coming from to pay for this this expense. So, is it coming from your reserves? Is it coming from, you could say, capitalized? So capitalized section means that it's coming from the acquisition price. So if you make that capitalized, that $75,000 is now going to be included up here. So it's $375,000. So that's going to be factored into the loan amount, and we haven't even gotten to the loan section yet. I know it's a little it's a little long, but I want to be very thorough, and you can skip through parts of this video if I'm moving too slowly. But you'll see it's part of that loan section. So what did we say? It comes online in month 24. So it comes online in month 24, but it comes online down here, I think. Let's see. All right, I guess I'll have to figure this part out for the capitalized, but let's just say it comes from the reserve funds. So you'll see month 24, 75,000 reserve funds. So you come to one-time CapEx costs, you come to month 24, you'll see it's $75,000. So your NOI at month 24 is 20,000. You're subtracting out 75,000. So your total NOI less the capital cost is $54,881, right? Because you have 20,000 of NOI, but then you're paying 75,000 for the capital cost, so you're out $54,000. Well, based on the amount of reserves you have $5,750 worth of reserves currently. So we're going to say that all of that is going to pay off however much you can of this negative balance. So the total amount that you'll actually be down for adjusted NOI in this month is $49,000 once you use those reserves to pay back the some of that negative cash flow, which means that at the end of the day, for that month, once you factor in the debt service of $3,767, you're actually out of pocket $52,000. So that'll show you how much equity that you'll have to actually bring to the table for that month. So that's if you choose to have the cost come out of the reserves funds. Again, that's $75,000. What you could also do is have it be financed. So let's say you're getting another loan on this $75,000. So this says error, right? And I'll show you why in a second. And that's because you have these two line items showing finance. You can only have one of these line items showing finance. So let's move this to reserve, and then this will say okay again. So if you make this finance, then what happens is if you come back to the Underwriting tab, the reserve and CapEx financing section, you'll see it'll have common area here, and it'll show month 24, 75,000. You can then choose what the loan to value. So what equity do you need to pay of the 75,000? If you're saying 50%, that means you're paying 37,500 out of pocket, and then the remaining 50% will be loaned to you. You can choose the loan fee, the interest rate, and payment. So this is the interest rate. This will show you what you're paying. So based on the loan term. So let's say it's a 12-month loan term, paying $3,202 per month. Let's say this is a 70-month loan term. You'll notice you're paying off the loan in month 36 after 24, right? Because 36 plus 24 is 60, and we're selling the property in month 60. So you need to make sure that you have no liabilities on the property. This would essentially be an outstanding liability. So it'll show you in month 30, in month 60, which is 36 months after you take the loan out, you're paying off the remaining balance of $19,441. So let's make that 12 again. So now what happens is you'll notice in the capital expenditures section paid on equity, you're paying that $37,500 in month 24. And then you have this total CapEx loan section. You'll see you're paying $37,500. The loan fees that you're paying $37,500 because that's the equity section. But this is the loan amount. So if you, right now it's 50-50 split, but if you made this, let's say 70%, then you're paying $52,000 in equity. The loan fees you're paying $52,000. I'm sorry, you're paying $22,500 in equity. You're getting a loan of $52,000. You're paying $525 in terms of the loan fee, and then here are your debt payments per month. And then you'll pay off the loan in month 36 right there. And that is how we're factoring in for the total CapEx if it's a loan. Go back to the other assumptions. If you turn this back to reserve funds, you'll notice we have no CapEx coming from the loan anymore. So if you go to underwriting, you'll notice that reserve is now not applicable because you don't have any CapEx that you're financing. So it's month 0. And if you come down to this CapEx section, there's nothing there anymore. So let's now dip down to we talked about the reserve section. Let's dip down to the financing section. So I know we kind of went a little bit out of order. We spoke about the CapEx financing section, but let's go to the acquisition loan and the permanent debt. So you'll notice in the financing assumptions, those happen right here. So you can choose what loan to value your acquisition loan is, right? So right now we're saying that the asset is $1.1 million. If we're borrowing 50%, your loan amount it's not just on that 1.1, the way that we have this structured, it's your loan amount on the immediate CapEx, the closing cost, the broker fee, and the purchase price. But again, we can update this so it is just the purchase price. But right now we're taking the loan amount on the entire acquisition cost, the total acquisition cost, right, of that 1.425 million amount. So based on the fact that you want to borrow 50% of that, your loan amount is $726,000. The loan fee is a percentage of your choice. So if you want it to be 1%, then that loan fee is a percent of the loan amount. Then you choose your interest rate, amortization period. Is there any interest only? So is this an interest only loan? If so, type in however many months of IO you'll have, and then you'll notice this will show you what your amortization payment is. So assuming principal and interest. And if you just have interest only, this is what your interest only payment is. And you'll see you have this payoff date right here. So this payoff date will either equal the sale date of the asset if you say you're not going to have a refinance, right? So if you have no refi, the payoff date will equal when you're selling the asset, because that's when you have to pay off the lender with the proceeds at sale of the asset. But if you're deciding to refinance, you toggle that to yes, and you'll notice this now pops up refi date. So you can choose when you're refinancing. Let's say we refi in month 30. You're refinancing in month 30, and you'll notice now the payoff date is month 30 because you're paying off the outstanding value of the loan amount based off how much principal you're paying off. You're paying that off in month 30, and then you're taking out a new loan at a new LTV based on whatever cap rate at refi you're using. You plug that in, and then it's generating the value of the asset using your cap rate by finding the NOI in month 30, that payoff value, multiplying it by 12 and dividing it by that cap rate. So you just have to be careful where, in month 30, for instance, here, you're 100% occupied, and it'll actually show you down here what your occupancy rate is. But if you were to use, let's say, month 36 as an example, right? Let's say we're refining in month 36. Now your occupancy is 67%, and this is generating value based off the occupancy. So you'll notice the value dips drastically because you're not maximizing the NOI there. So again, here's a refi amount, and you can again plug in your loan fees, interest rate, amortization period, IO, and then this payoff date will be the difference of when you're refining and then when you're selling the asset. And it'll show you the payoff value. That's what you're paying off when you sell the asset. So now if we go down to the financing section, remember we have 12 months interest only payment, and then the remaining balance will be amortized payment. So if you come down to the financing section, you'll notice in the acquisition loan section, you're borrowing that $726,000. You're paying, so that's showed as a positive inflow. You're then paying $7,263 in terms of loan fees for the first 12 months, right? We said we're only using interest only. That's what your interest only payment is. So you're not paying off any of the principal. But then in months 13 thereafter, you're paying the fully amortized amount, which is that $3,700 figure, and you're paying that until you refi in month 30. In month 30, the last day of that month, you're paying that loan amount, and then you're also paying back the outstanding balance of the loan. And based on the fact that, what did we say? We are financing 50% of that new value at a 5.5 cap is going to be $4.4 million. We're taking $2.2 million out because we're taking 50% loan on that $4.4 million. You're paying your fees, and then thereafter you're paying the mortgage payments. But you'll notice based on the difference of paying off the first loan outstanding balance of $700,000 and having the permanent or getting funding for 50% of the current value in month 30, you're getting $2.2 million. This is actually cash out refi of $1.48 million. That's going to be reflected on your bottom line. So it's at $1.48 million plus that $20,000 in adjusted NOI, which is again that $20,379 less your reserve, the amount in reserves you're taking out, and that's going to total that net levered cash flow figure of $1.508 million. I hope that makes sense. You could fiddle with these numbers and see how that changes. So now you'll see this total acquisition loan is in place until month 60. And then in month 60, you're selling the asset. And again, you're selling it for the way that we're valuing the asset upon sales. We're using a exit cap, and then we're taking the NOI of the 12 months in the future of month 60. So from, month 61 through month 63. And you'll notice this is showing you what the occupancy figures are for month 61 through month 73. Month 61 through month 73. So if we just hard code, just to show you, for example, month 70, month 70, and we make that 0% occupied, then you'll see your total occupancy is 92, and obviously the operating income will be reflective of that, which will bring down the NOI, which will ultimately bring down the value of the asset at sale. So, you just want to make sure you're maximizing. You want this to be 100% when you're selling the asset, so that you're maximizing the value you're getting at sale. You have selling costs associated with that. So again, for this, you're taking the 12 months. You're taking, what is this? Yes, you're taking the 12 months, the NOI 12 months prior, 12 months in the future for the asset, and then you're dividing that by the exit cap to derive the value. Then you're subtracting out the closing cost or the selling cost, and that brings you your net reversion value, your net sale value. In this case, it's $4.5 million. And once you pay off the outstanding payment or the outstanding loan amount for the refi, you're left with, a total of that 4.5 minus 2.14. So you're left with a total of 2.45 million. And you'll notice when you add back in the NOI for that month, and then also the amount of reserves that are still in your reserve account that you didn't deploy. That's technically your capital as well. So you add all those figures back and you're at, what is that? Total of 2.478 million, which is 2.478 right down here, which is the sum of those figures that we just highlighted. And that brings you to the net levered, net unlevered cash flow section, right? These are just the cash flows assuming no debt. So assuming no debt, you're taking the total acquisition cost, adjusted NOI, and here because we're assuming no debt, we're taking just the CapEx for, on the CapEx that you are getting a loan for, we're just adding the amount that you are getting that loan for into the unlevered amount, because if you're not getting a loan, you're not going to get a loan for that amount, and that's just going to have to come out from equity. But you're not really going to look at this number as much as you're going to look at this bottom number, the net levered cash flow section, and this is taking into account debt as well. So you'll notice what we're doing is we're just adding in the net unlevered cash flow, and then we're adding in the debt section. And then here, because we subtracted out before the loan amount for the CapEx section, we're now just adding that back in. So that is your net levered cash flow, and that is the underwriting tab. I think we went through all of this. Down here, you'll just see some metrics, some general metrics, right? You've got, based on your net purchase price, this will show you what your going in cap rate is. So this is going in cap rate. It's taking the in-place effective gross income. And what is the in-place effective gross income? It is times 0 when you buy the asset, if there's any current leases in place. So, right, we said there's 33% of leases currently in place, generating $69,000 to almost $7,000 in revenue per month. 7,000 times 12, right? That's going to give you that $83,000 based on the effective gross income divided by the annualized effective gross income divided by the purchase price. That's going to give you the going in cap rate, and then month 2 stabilization, right? These are just phony numbers that I plugged in, right, in terms of the rents and the square footage. But you'll see based on the time you're stabilized, it takes the NOI at stabilization, annualized, obviously, right, divides by the net purchase price, which is that 1.1 figure, and that's going to show you what the stabilized cap rate is. You can also see what the reported cap rate is. So based on the total acquisition cost, which is that 1.42 million, right? It's that total acquisition cost divided. It's the NOI at month 2, so the actual net operating income, not just the effective gross income. It's the net operating income divided by the total acquisition cost, and then you see it at a square foot basis. And then finally, when you exit, it's showing you what that reported cap rate is for the total project cost, because we might have, again, factored in some capital expenditures some other place between month 1 and month 60, right, between acquiring the asset and selling the asset. So that just takes in to affect your NOI at sale, and then divided by all of the costs associated with acquiring and maintaining the asset. So it's all the CapEx plus the total acquisition cost. So that's the total project cost. And then obviously you're going to be selling it at a different cap rate, right? You're going to be selling it at a cap rate that's more in line with what everything is doing in the market. So let's say you sell it at a 5.5 cap, you're able to see what the spread in terms of basis points are that you sold the asset for, reported based on your acquisition cost and the cost associated with the life of the project versus the exit cap. So here, really, really good project. You'll notice up here, you've got property level returns. Down here, you have partnership level returns. Property level returns are the snapshot from below. It's the unlevered section over here, profit IRR equity multiple. Then you have the levered section over here, profit IRR equity multiple as well. Obviously, the profit's going to be less than the profit of unlevered, but the IRR should be more, so should the equity multiple. Then we have the partnership level returns. So this is a good segue into that partnership return section. But essentially, this is a snapshot of the general partner's profit IRR equity multiple and the limited partner's profit IRR equity multiple. So let's go into the partnership return section. Zoom in a little. So this is showing what the general and limited partners are making based on splits, equity splits, based on distribution hurdles, and based on fees. So right here, you'll notice we have the fee section. So let's start with this. Start with the net property level cash flow. This is tied to the underwriting tab, net property level levered cash flow. Then what we'll do is we'll add in the fees. So we say that there's an acquisition fee, right? You can make this whatever you'd like, 0, 1%. But essentially all of these fees from acquisition to disposition, this would be a fee that's incurred at a fund level and then paid out to the sponsor. So if you say the sponsor or the GP, right, the general partner. So if you say the acquisition fee is 1%, the incentive management is 2%, the disposition fee is 1%, you'll notice the general partner is receiving all of these, and all of these are being factored in at a fund level. So the GP is actually, it's kind of interesting, right? The GP is paying 5% of these costs to himself, but that's just how we have it modeled out to be most fair. And then the debt placement fee is what you're going to be paying, let's say, some debt capital, someone who's helped you raise capital, so the GP won't be seeing that, but that'll be hit at a fund level. And that, once you factor in all these fees, that brings you the net fund level cash flow. And this will show you, right, based on the inflows and outflows of the project, this will show you how much equity is required. So right now we have calculated equity. So this is saying that the equity is contributed to the property based on the negative cash flows. So here you'll notice, right, we have a distribution of $16,087, even though the incentive management fee kicks into place here. This is driven off of this, so there won't be a fee to the GP until the property is actually generating positive cash flow for the fund. Here, for instance, you have negative $13,585, right? In any of these, you could see you have another financing fee because this is when the refi happens. And then here you have the disposition fee because this is when the sale of the asset's happening. But essentially, you'll know for this project now, based on the calculated equity, that you need to bring $757,000 to the table. You could say, okay, what percent is the GP bringing? Let's say they bring 10%, and the LP will bring in the remaining balance, so 681. The GP is bringing now 75,000. And then based on the equity contribution, that's obviously for every dollar that goes to the project, the general partner is bringing 10 cents of that, the limited partner 90 cents of that. But then we have the distributions. So again, we're using a 4-tiered equity waterfall structure and with different promotes. So if you say that every dollar that comes out of the project is just distributed, what they call pari passu, but essentially 10% to the general partner, 90% to the limited partner. Let's say there is no promote. You'll notice that the profits are different, right? Obviously, because the general partner brought a different amount to the table than the limited partner. And you'll also actually notice right now that the IRRs and equity multiples are different too because the GP is receiving fees. But if we zero out the fees, you'll notice then that the total IRR for both the GP and the LP and the total equity multiple for the GP and the LP are the same. However, what we could do is we could set incentive hurdles, right? So these IRR hurdles saying that if the project generates, let's say, in excess of 8% IRR, between 8% and 12% IRR, this should be IRR, not equity multiple. We can fix that. So if the project generates between 8% IRR and let's say 12% IRR, then the general partner gets an incentive. Let's say the promote in that case is 20%. So based on the fact that the GP is bringing 10% equity to the table with a 20% promote, that means all distributions that come to the property where the property where the LP has received 8% IRR already, and now any distribution where the LP is receiving between 8% and 12% IRR, that will be a distribution of the dollar. So 28 cents of the dollar will be going to the GP, 72 cents on the dollar will be going to the LP. So between, let's say, 12% and 16% IRR, let's make this 30% promote, which means the distributions will be split 37% to the GP, 63% to the LP. And finally, let's say anything in excess of 16% will be 40% promote, where you have 46 cents on the dollar going to the GP, 54 cents on the dollar going to the LP. This project at a fund level is generating 81% IRR, which means that that last tier will definitely be hit, right? So you'll notice the general partner is receiving 170% IRR, the limited partner 62% IRR, because you have these incentive hurdles in place for the GP to really try to maximize profit as much as possible, because that will maximize the general partner's returns. Obviously, it will also maximize the limited partner's returns, but this is just the distribution method. We used IRR. Okay. What you could also do is, very quickly, right now it's set to calculated equity. You can change this to override equity. Right now, the whole model is freaking out because this is set to 0. So with calculated equity, you know that you're going to need $746,000 and $746,002, right? And that's saying that that equity is contributed when it is at the time it's needed for the property. Well, what if you need to collect all the equity up front? You could take that 746 number, and you could say, we need to contribute that up front. So let's say it's 746,002. That's being contributed up front. Now, obviously, the IRR has changed in the project because the returns, obviously the profit's going to be the same, but in terms of the timing assumptions, that changes because now all the equity is contributed day 0 instead of throughout the life of the project, which is going to bring down the internal rate of return, which obviously is going to affect the distributions from the property going to the LP and the GP. And if you want to be a little more careful, you could say, all right, well, maybe we'll need $1 million. And then obviously if the general partners the limited partners bring in $900,000 at time 0, that really is going to impact the bottom line in terms of the IRR, because now, they bring in $900,000, they're getting the same return, and they're going to need to get their principal back before the equity hurdles come into play. So let's change this back to calculated equity. Okay, so we covered partnership returns. Annual summary is just a snapshot of everything. You'll see you have cash on cash, and this is factoring in the cash out refi. So you'll see obviously it's 198%, so that's pretty drastic. But if you have no cash out refi, right, let's say there's no refi here, go back to annual summary, still pretty significant, which is great. But this is the cash on cash based on the costs that you're putting in. And remember, we have CapEx, more CapEx coming in terms of TIs and leasing commissions in, year 4. So that's why the cash on cash decreases for that next period, that next year. You could see what part of the project is coming from the cash flows, so like the adjusted NOI, versus what part of the profit is coming from the refis / the sale of the asset. So this is just showing you that, if the value of the asset remains constant and you sell it for, again, that like $1.1 million that you bought it for, you're only going to profit $19,000. So you gotta hope that it appreciates in that sense. And this is where you see that total net levered cash flow. The difference between that net levered cash flow number should equal that total levered IRR. So the income and cash flow section up here plus that residual / refi section over here. So that 3.9 will equal that 3.9. Finally, let's jump into the lender summary. The lender summary, now you could see, right, this updated automatically based on your inputs. So you'll see what your debt request is. You are financing 50%, so that makes sense, right? If you're responsible for bringing in 726,000, you want to take a loan out of 726,000. This shows the lender what their contributions are, their total contributions are, what their total distributions are through the life of their hold period. So in this case, it'll be 60 months, right? Because you're not refinancing. So let's actually do this. Take out that page one section. So you'll see here's the investment description. It shows 2 tenants, 7,500 square feet. This will update automatically. This will show the debt request per square foot. Office, Class B, built 2005. This 123 Test Avenue, this updates automatically based on the inputs in the underwriting section. So does the rest of this. This shows the exit month for the lender, the proceeds that the project is getting at exit. So again, if they're looking for $726,000, if you're looking to get a loan of $726,000 and they know when you sell the asset based on your assumptions, you think you're going to get $4.6 million, they know that their initial loan is more than likely going to be able to get paid back. This is showing them what their IRR is, debt service coverage ratio at stabilization, proceeds multiple, the debt yield, again, the duration of the loan. You have the sources and uses. So again, debt, this is how much debt you're bringing to the table. Equity, this is how much equity you're bringing to the table. That totals the total sources. For the uses, you have purchase price, closing costs, CapEx. And you'll notice that this equity, that's 733,513, that's going to look a bit different. Where are we? Than the amount partnership returns. Then the amount that you need, right? 731,006. And if you go back to the lender summary, this is 733. And the difference is because you have NOI that you're going to be using some of your positive cash flows in NOI to pay off some of the costs for the capitalization. But the lender doesn't need to know that. They just need to know that your sources equal the uses, and you're going to be bringing equity of $733,000 to the table. That covers the purchase price, the closing costs, and then the CapEx. So then we show what the total unlevered profit of the project is, what the total levered profit of the project is. Over here, it shows what the revenues of the project are at stabilization, what the expenses are, what the total NOI is, and then this again shows month 2 stabilization versus month 60 exit, what the NOI is, what the cap rate is. So again, this is based on the calculated cap rate, and this is based on the cap rate you're selling the asset at. You have total value per square foot, and then you have cash on cash. You have the occupancy, so your stabilization is at stabilization you're 100% occupied. At sale you're 100% occupied. This is showing what the operating income and expenses look like throughout the life of the life of your hold period, so 60 months. It's actually showing you, it'll always show you the first 60 months, even if you sell it in month 100. You have the project sources equaling the project uses. This updates automatically. Same thing here. Project source schedule equaling the project use schedule, right? You're going to use all the equity first, and then you use the debt. Here, this is showing the purchase price, closing costs, and then the CapEx costs. And then this is the annual snapshot. And then again, you can add a picture. You print this out, right? It looks nice and neat. You can just hand this to lenders. Hopefully that helps you get financing. So I appreciate your time. I know, again, this is a very long video. I wanted to be as thorough as possible. Feel free to skip through as much or as little of the video as you'd like, but hopefully this covers any questions that you might have. I think the only part that I will go back and just double check on my end is this part right here, the capitalized section. I'll make sure this is fixed and up and running before before I put this live. But yes, feel free to reach out with any questions. Really appreciate you taking the time again, and I hope to have the pleasure of working with you soon. Appreciate it, and have a great day.